back.
Gentleman's time has expired. The gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
Thank you to the chairman and ranking member and to the regulators for appearing before the committee. I want to start by saying the work that was done to address the Silicon Valley and Signature Bank collapse and ensure the health and resiliency of the U.S. banking system is vital. And I want to commend those that were involved in the swift action and the decisive steps that were taken to protect businesses' payroll, particularly small businesses and their employees who we heard from at that time. Now, while depositors were protected, shareholders and bondholders need to bear the cost for any potential mismanagement. And I'm eagerly awaiting the full examination of these bank reviews and the upcoming reports that you will be providing. Now, while the collapse of the Silicon Valley and Signature Bank may have occurred due to unique and isolated factors, the panic that their failures caused quickly became a private or a sector-wide issue. And I'm glad to say that the original crisis of confidence was subsided and cooler heads did prevail. I fear that the consequences will continue to materialize as we go on. For example, consolidation of deposits within the largest systemically important banks will only continue if the sense of risk within the financial system persists. Uninsured depositors are leaving our mid-sized banks because they feel that their money is safer elsewhere, even as these banks showed continued strength and sound financial footing. Deposit insurance is crucial for many of my constituents to get a sense of peace of mind, and we cannot have the perception of a two-tiered banking system in this country where only the largest banks are protected. So, Chairman Gruenberg, as we look to increase confidence in the banking system with a particular focus on small and medium banks, how would an increase in the FDIC insurance limit prevent further consolidation of deposits at the largest banks?
Well, I think, Congressman, I think that question is raised by this episode. The decision to guarantee the uninsured deposits of these two institutions really have implications for the entire deposit insurance system, and we need to consider it. And I'd like to do it comprehensively, looking at all the aspects of our deposit insurance regime, and then come back by May 1 with a report that the FDIC will put out, which will also provide some policy options for consideration.
All right, one other area that I'm concerned about, I've already heard multiple development projects, particularly housing projects in my district that are struggling to get financing due to a pull-up back of credit from community banks. While I understand the need to review capital requirements, I think you'd agree, Vice Chair Barr, that no bank can meet $40 billion plus in depositor demands from capital alone. So, Vice Chair Barr, I would really urge you to consider the effects of increased capital requirements on the lending of healthy community banks. However, I do believe that action must be taken. So would you be able to discuss any additional strategies the Fed would be able to pursue to address the problems that we have seen at Silicon Valley and Signature Banks without reducing credit industry-wide?
Thank you very much. First of all, the capital review that we're doing does not apply to community banks. We're not intending to increase capital requirements on community banks. My understanding from looking at the community banking system is that it is well capitalized and stable and is serving its communities. We are looking at larger institutions. If we do that, we're going to do it through a notice and comment rulemaking process. That takes a good bit of time, and there are transition rules. So we're not talking about capital rules that in any way that would apply now. We're talking about how to make sure that the capital and liquidity rules in the future are appropriate.
Okay. And then finally, there were reports that after Silicon Valley went into receivership, they literally advertised that their FDIC guarantee as a way to attract depositors. Is that true? And if so, what's being done? They cannot now benefit from the policy after we helped save them.
That's a fair question, Congressman. We placed Silicon Valley into a bridge institution there may have been some communications of the kind you described. When we heard about it, we put an end to it.
Thank you. Thank you, Mr. Chairman. I yield back.
Gentleman from Nebraska, Mr. Flood, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Vice Chair Barr, you've disclosed that Silicon Valley Bank's composite CAMELS rating was a 3 out of 5. In response to Ranking Member Waters' question earlier, you disclosed that their liquidity rating was a much stronger 2 out of 5. Furthermore, you testified that the Federal Reserve examiners cited Silicon Valley Bank 7 separate times, and you testified that examiners were aware of Silicon Valley Bank's interest rate risk last year. Why wasn't that risk reflected in Silicon Valley Bank's liquidity rating?
I think it's an excellent point. One of the things we're looking at the review is, given the extent of difficulties, the problems the firm was having, how did the regulators come up with this particular, the supervisors come up with this particular approach? Its composite rating was not well managed, and its holding company rating was deficient, that is also not well managed. But it has a 2 for liquidity and it conditionally meets expectations for liquidity. And so we're trying to understand how that is consistent with the other material. I mentioned earlier, too, that, I'm highlighting the liquidity and governance and interest rate risk findings, but there were many other findings at the firm that had not been addressed at the time they failed. And so the question is, why wasn't that escalated and why wasn't further action taken? I think it's a legitimate and fair question.
Was that composite score, that composite CAMELS rating, ever downgraded in 2021 following the examiner's citations?
I don't know the answer to what happened in 2021. The 2022 rating was the first time the firm had a composite rating for all of its activities as it entered the large and foreign banking organization group.
Vice Chair Barr, was Silicon Valley Bank's liquidity rating ever downgraded following the examiner's citations in 2022, or is that the same issue as you just described with the large bank status, their liquidity rating?
The overall rating for the firm, of which this would be a part, was done that summer. There was a process after that of looking at both liquidity risk and interest rate risk. And my understanding is, as part of the horizontal review that was being conducted at the beginning of 2023, the examiners were looking at, what was the appropriate level.
Okay, every quarter the FDIC releases its quarterly banking profile. This profile includes a public disclosure of the total assets of FDIC-insured institutions that are deemed, quote-unquote, problem banks. In December of 2022, the FDIC's problem bank list included total assets of only $47.5 billion. Although the banks on the FDIC's problem list are not public, given the size of Silicon Valley Bank, it's reasonable for me to conclude that Silicon Valley Bank was not on the FDIC's problem bank list, released just 3 months before its collapse. Mr. Chairman, given the several supervisory findings identifying various issues with Silicon Valley Bank's practices since 2021, including the issuance of matters requiring immediate attention from those supervisors, were those findings communicated to the FDIC?
I can tell you, Congressman, that the criteria to get on the problem bank list is to be rated a 4 or 5 on the CAMELS rating scale of 1 to 5. And at that time, Silicon Valley was not rated a 4 or 5, so we wouldn't have been in a position to put it on the problem bank list.
Vice Chairman Barr, why wasn't this information shared for the purposes of the FDIC's problem bank list?
As Chairman Grumman just indicated, the FDIC makes an independent judgment with respect to its list based on the ratings of the firm, and the firm was not rated lower than a 3.
Chairman Gruenberg, has Silicon Valley Bank ever previously been on the FDIC's list of problem banks?
The reason I hesitate is we put the aggregate assets of the institutions on the problem list. We don't indicate the individual institutions.
Here you can do that?
No, I take your
point. And this is a question from Congress.
Yeah, well, I believe I can come back and answer your question if I may.
Yep.
Could we follow up for the record? But be glad to do that. I just want to check, but yes, the answer is we'll come back with an answer.
The answer is yes?
We will come back with an answer for you if that's okay.
Okay. Thank you for your testimony. I still think there are lots of questions regarding what happened here, especially with Silicon Valley Bank, and I appreciate your time. I yield back.
I'll go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Let me thank all of you for your responsibilities and the duties and what you've done. You know, it's funny when you've been here for a while, you know, a lot of folks are here talking about Dodd-Frank should be the golden rule, but if you were here in 2008 when there was no Dodd-Frank, that was a crisis. That was something, this is nothing, I mean, I wish some of my colleagues who are here, who were not here, we are a long way away from where we were in 2008. And the bank's system is much stronger now than it was 2008. And I say thank God that we had Dodd-Frank at that particular time. So I want to thank you for that. But as a result, let me just ask, maybe Vice Chair Barr, as part of your internal review, you've indicated that you plan to evaluate whether the application of more stringent standards would have prompted SVB to better manage risks. So as part of that, do you expect to look into whether more frequent stress testing for a bank of SVB's size would be appropriate?
Yes, Representative Meeks, we'll look at stress testing. We'll look at really all the enhanced prudential standards, liquidity standards, capital standards, stress testing. All of that will be part of our review with respect to SVB, and it'll help inform broader questions we've been working on since I arrived in July about what the capital framework for the system should look like.
Now, are stress test results for our largest banks, those that are above $250 billion, they are available to the public? Is that not correct?
Yes, the stress testing results are available annually to the public.
And I understand that because of SVB's rapid growth and the timing of when the bank crossed the $100 billion asset threshold, SVB would not have been subject to stress testing until 2024. But when a bank with about $100 billion in asset size is subject to stress testing, who has access to those results? Would, for example, an individual or small business client of the bank be able to see those results?
So under the current framework you correctly described, the Federal Reserve's rules established in 2019 would provide that SVB would be subject for the first time to stress testing in 2024. There is currently, under that structure that was put in place in 2019, no stress testing for firms below the 100 billion level, and that's part of the framework.
So could you expound a little bit more on how helpful it might be for a depositor, for example, to get to see those results, especially depositors who are uninsured, that have uninsured deposits?
So stress testing results for the firms that are in stress testing are published annually. For firms that are below that level in the current framework, they're not required for that kind of stress test. They do internal liquidity stress test as a normal part of their requirements on a quarterly basis. That's an internal proprietary action by them, subject to supervisory review. In the case of SVB, they conducted their liquidity stress test, but the supervisors found that those stress tests essentially were not stressful enough. They were not realistic.
So, I mean, that's, but I believe there's an issue that customers and investors who bank with institutions that are large enough to have triggered a systemic risk exception do not have the transparency into the risk management and scenario plan that their banks may have underway. But in the limited time I have, let me just follow up on a couple of questions that some other people had asked. I am thinking about small banks and community banks, which are very important, and talking about depository insurance, and I know someone was talking about that. Now, to me, not a lot of people, especially in the community banks, have $250,000 in the bank. So this would, but in trying to help strengthen those banks, What I would like to see is some of the small businesses may have more than 250,000 in the bank, and they have to pay employees, and I would like them to be giving them some business. So do you think that, and I don't know, but that there should be some, when you look at depository insurance, a difference between small businesses and personal, you know, as far as that's concerned going forward?
Congressman, that's a good question, and it's one of the things we'll be looking at in the report that we're going to submit on May 1 and laying out some policy considerations to take into account here.
Thank you. I'm out of time, so I'll yield back.
Another gentleman from New York, Mr. Lawler, is recognized.
Thank you, Chairman. Chairman Gruenberg, just to follow up on that line of questioning, yes or no, should the FDIC insurance limit be raised?
Let us do the work on this and then come back to you with a report.
Well, in the 2008 collapse, we raised it from 100 to 250,000. We made it permanent in 2010. It has not been raised since then. Do you think it should be raised?
I don't know the answer to that question right now, Congressman.
Okay. Did the Fed, the FDIC, and the Treasury have the tools needed to deal with this crisis when you were made aware of the situation with SVB? Do you all believe, yes or no, that you had the tools needed to deal with this?
Yeah, yes, we have the tools we need.
Yes?
I agree, yes.
Yes?
I agree. We had the tools to
Okay.
prevent a
Did the Fed, the FDIC, and the Treasury have the tools needed to prevent it? Yes or no?
I think that's a very difficult question to answer. I don't have a yes or no answer for it. I think we can do better at supervision and regulation, but whether we could have prevented the collapse in 24 hours of this institution, I don't know the answer to that.
I agree with Michael's point, but from a supervisory basis, I think there was an opportunity.
I'm sorry, Congressman,
Yeah.
can you repeat your question?
Yes or no? Do you think the Treasury had the tools needed to prevent this from happening
The Treasury had the tools to use the systemic risk exception
and used it?
and recommendation to prevent a crisis.
So the FDIC and the Treasury do believe it. The Fed, not sure yet. But so in that case, do you think the Federal Reserve failed here in its role?
I think fundamentally, as I've said, it's the responsibility of bank management to run the bank. The bank managers failed in basic risk management.
Right, but you provided, the Federal Reserve and the San Francisco Fed provided guidance, provided notices, and failed to follow up on that, correct?
I would say that there was follow-up. The question is whether the follow-up was stringent enough, and that's part of the review we're looking at.
But stringent enough really means that the individual people may or may not have done the job that they were supposed to do, correct? Because if you give the notice and you reach out, isn't it incumbent on the individual supervisors to actually follow up and make sure that the bank is doing what it needs to do?
It's incumbent on the bank to take the actions that the supervisors are directing them to take, and it's incumbent on the supervisors to check on that.
Did the supervisors fail to check on that?
No, I didn't say that. What I said is that it's incumbent on the supervisors to do that. I think it's a
Did they
legitimate,
do that?
I think it's a legitimate and fair question to ask whether they were stringent enough, whether they used enough tools to force the bank managers to do what was obviously right.
With respect, that is semantics. Did they do the job they were supposed to do? Did they follow up?
The reason I'm having difficulty answering the question is I believe they did follow up, but the bank managers did not perform on the job, and that's why we're looking.
Were California and New York regulators equipped with the appropriate tools to handle this? Or should these banks, specifically SVB, given their size, been federally chartered instead of state chartered?
I think that our country benefits from having a wide diversity of kinds and sizes of institutions and the diversity of chartering authorities that we have, so I'm not recommending that we change that.
Okay. When did any of you first speak with Superintendent Harris regarding Signature Bank? Just date, please.
I'd want to check the record on that if I may. I will come back to you. I just want to be sure we're accurate.
Okay. Do either of you know when you first spoke to Superintendent Harris?
I do not. I mean, Signature Bank is an FDIC in New York, state-regulated institution, but I don't know when I first had a conversation about it.
Okay. Chairman Gruenberg, when was the decision made to close Signature Bank, and what criteria were used to determine whether or not Signature Bank met the systemic risk exception?
Those are two questions, Congressman. The decision to close the bank is the authority for the state, and the state made that decision on Sunday. And what was the question in regard to the systemic risk exception?
What criteria was used to determine that?
Oh, I think we had before us the a failure of two institutions, both Silicon Valley and Signature, and we also had before us evidence of significant liquidity stress at other institutions, and we had data in terms of deposit outflows, and I think that was basically the data we relied on in making this judgment.
If the chair will submit that data for the record and answer for this,
Yes.
would you be willing to do that? The data
Yes, of course.
related to systemic risk designation.
Yes.
Okay.
Thank you,
Or
Mr. Chairman.
systemic risk event.